Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, I'm going to start this week's show talking about currencies. Now, until recently, currency markets have not been doing a great deal. They've been fairly calm compared to equity and bond markets, but that's changed in the last sort of few days and particularly last week. If we look at the pound dollar exchange rate. Now, the pound fell through the $1.30 range, which is a key support and resistance level. So when we fall through it, that becomes a resistance zone and caps the pound from rallying. So it has to break back through that. Now, we've gone down below $1.30. We actually went below $1.29. Now, the reasons for that are twofold. There were concerns over the Brexit negotiations that were going to be going on with the European Union this year and what sort of outcome we would have and whether we would ultimately end up with some form of harsh no-deal type of Brexit. But also the US dollar has been rallying, and part of that is down to fear. So when you get periods of fear, then people tend to buy the dollar. It's one of those haven currencies, a bit like the yen. So the dollar has started to strengthen against the pound. And the other thing that's caused people to start taking bets on the dollar is there's been less noises from the Fed about interest rate cuts. So when you get an interest rate cut, it tends to put downward pressure on a currency. But people are starting to think the Fed isn't dovish enough, and so the dollar started to creep up and rally. Now, if you look at the US dollar index, which is a broad measure of the strength of the dollar against a basket of currencies, we've actually rallied back above the 98 level, actually 99. So the 98 level is quite an interesting level. When we tend to be below that, that might be a sign that you're going to get more weakness. Above that, you tend to have a bit more strength. So the dollar has gone from a bearish pattern to a bullish one. And that often happens in periods that we're entering into, which is perhaps the later stages of an economic cycle. Now, you will have seen the impact of the US dollar pound exchange rate on your portfolio. So when it weakened, it gave your overseas holdings a nice boost. But in the last couple of days, we started to see the pound strengthen again. And that's because there's been noises made about the upcoming budget in the UK. And there's hope there could be some sort of fiscal stimulus. So some policies that are announced that could help boost economic growth in the UK, which is obviously positive for the pound. So the pound started to pick up again and push towards that $1.30 level, which therefore hinders your overseas holdings. So what you're seeing a lot of is the FTSE 100, which is very influenced by that exchange rate, start to rally and fall. So that is going to be an exchange rate to keep an eye on in the coming days. Now, if you move on to other currencies, we've started to see some quite big moves in currencies globally, particularly in emerging markets. And a lot of that is down to the coronavirus. Now, since the start of the year, the Australian dollar has fallen more than 4% versus the US dollar. Now, the Aussie dollar is almost a proxy for global growth, and particularly growth in China, because of their economy is very dependent on the export of commodities to China itself. So that is why you're seeing their currencies fall. But we're also seeing emerging market currencies fall as well. So we're starting to see some more movement in currency markets, largely as a result of the coronavirus in overseas emerging markets. Now, if we go over to equity markets, the story has been very positive this week. So if we look at earnings season, that has been pretty much on a par with previous years. So we've had 3/4 of the S&P 500 companies actually report their earnings, and they've beaten expectations by around about 5%. And that's on par with what we've seen in the last 3 years. So in that respect, earnings season has been okay. It's not been disastrous, it's not been amazing, but it's been sufficient. But what's happened, we've seen the markets rally to all-time highs. Now that's in America, but also globally. We saw new all-time highs on the MSCI World Index. And now why is that? We've seemed to have got this weird narrative change. So if you remember, the coronavirus was initially deemed very negative for equity markets. It has an impact on supply chains for companies such as Apple in terms of trying to build their products. And that sent equity markets lower. But like past epidemics, these sort of impacts tend to be slightly short term. And we've seen equity markets rally again, and they had this narrative change that the virus, or the numbers that were being announced in terms of the people infected and dying, were starting to fall in terms of, I don't mean fall in their number, but in the acceleration of their growth. So that was suddenly a positive narrative, and the impact on global growth was going to be obviously some impact, but not too great, they were hoping. This is the market, but just enough to get central banks to start printing money again and cutting interest rates. And so we're getting into that Goldilocks world of where things aren't too bad or they aren't too good, they're just enough for central banks to keep the party going by boosting liquidity. But that is a very strange narrative. One week the coronavirus is negative, next week is positive for stocks. If you look at bond markets and commodity markets, they disagree. They have been pushing lower. So bond prices have been going up, their yields have been going lower. That's a sign that they think economic growth is possibly going to slow down into the next quarter. And if you look at things like copper and oil in particular, the prices have been crashing this year because of the fears over global growth. That's the real problem with the coronavirus now, is the long-term impact on global growth. And if we suddenly start to see that coming through in GDP numbers when they're eventually announced from the likes of China, but also when we see it perhaps have a knock-on effect globally, that's when the market could become very unsettled. And if you look at markets at the moment, equity markets, you can see how the fear evaporated this week. We had the VIX, the fear index, fall below 15. And if you've watched these videos or listened to this podcast, you will know that 15 mark is quite important. Below that tends to be quite positive and constructive for equity markets. Above that tends to be a little bit negative. But we've still seen the market rally even though the VIX had fallen below 15 and then bounced back above it. So is it the market being very strong and a sign of how resilient this bull market is, or is it a sign of complacency? Because there are these divergences, as I've mentioned, between asset classes out there that are all giving mixed messages. So we need to see what will happen in the coming days and weeks. And on that note, today it's been announced in China that the number of cases have gone up tenfold compared to the rate of increase yesterday because of a change in the way that the counting is done. And of course, that has had a negative impact on markets. So as I make this podcast and video, the FTSE is down more than 1%. The futures for America are pointing to a lower opening, perhaps down as far as 0.8%. We'll have to see what happens, whether this is just another blip as the market continues to push higher. What this shows is the news headlines surrounding the coronavirus and its spread are going to have an impact on equity markets and currency markets. But the long-term impact of the virus is still unknown, and we're going to have to see how it pans out in the weeks and months ahead. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com, Twitter, moneytothemasses with the number 2. You can find us on Facebook and of course on Instagram. And don't forget to subscribe to our YouTube channel.